To tell us more about the markets, we're speaking now with Suzanne Haddan, the Managing Director of BFG Financial Services. Suzanne, thanks so much for coming in.
Good morning.
As we saw mixed results on the market there, are things becoming a little bit more stable?
I think we need to accept that volatility is back. That's always an important element of the market, and I think we got a bit complacent over the last year or so with the trajectory up. Get used to volatility and some of the unusual outcomes that will give investors.
Have we got consensus on this? Is it being called a correction at this point?
Well, a correction is technically 10%.
Yep.
So we've had a correction, but we've just recovered a little bit from a correction. And the word correction is a lot more comfortable than the next word, which would be crash.
So are we likely to see a crash, or are we likely to see more corrections? What's the future hold?
You need to accept in the market that you will always see corrections, and periodically, maybe every 4 or 5 years, it's very hard to predict, you will see crashes. And that's why you need to take a long-term view when you're investing in risky assets like shares, so that you can ride out the highs and lows.
Now, this comes despite the strength, the obvious strength of the US economy. Certainly that's what Donald Trump would say. And we look at that compared with Australia, there is quite a significant difference, and that's borne out when you look at those interest rates, isn't it, essentially on bonds.
Yes.
Whereas, you know, in the States, they're on the rise. In Australia, they're sitting still at very low levels.
Yeah, well, a couple of days ago we had the instance where the 10-year US bond yield, the interest rate, exceeded the Australian 10-year bond interest rate. And that's the first time for 18 years. And I was reflecting, what does that mean? Goes to Andrew's point that the US economy is perceived as quite strong. You know, low unemployment, 4.1, targeting probably three interest rate rises this year. The issue becomes, though, traditionally when shares drop, bonds rise. But when interest rates rise, you can have this unusual time where shares crash and bonds crash. What do you do? What you need to consider is, if you haven't got time in the market, you should be going to a safe haven. And the only one left, because we've told you for years, diversify, have bonds, have shares, is cash.
Which doesn't get you a lot, does it?
It doesn't get you a lot, but you have the argument: are you interested in the return on your money or the return of your money? That's the question.
Safety factor there.
There's not just risk in the share market, of course, there's also risk in the housing market. We saw this huge boom in prices, and now we're seeing perhaps a correction there. There's been crackdowns on risky loans. Is that likely to continue, or are we likely to see them tightened even further?
It was great APRA, I remember last year, put a halt on so many interest-only loans, which is the risky end. But what they're saying now is that they want to see more money put aside as a capital buffer by banks for the investment loans, particularly the interest-only loans. And that results in interest rates going up. And coupled with many people coming off an interest-only loan, what happens is the bank says to you, right, your interest-only loan is finished, we'll offer you principal and interest with 60% more repayments. If you want to stay on interest only, you generally have to make almost a full application to do so. And that can result in you being assessed to service your loan at 7.25%, an 80% increase on what you're probably paying now. Many people can't do that. So what do? They either pay principal and interest at a higher rate, sell their property. We're already seeing a softening in the property market. You know, one of the organisations have submitted to the Royal Commission that we've had a 20% increase in 6 months in stressed households to 921,000. And that's because of the banks issuing loans, in their view, that people can't service.
So that's the slippery slope, isn't it? Because if you can't service your loan, you're forced to sell, prices fall, and it snowballs.
And coupled with what we all know is low wage growth. Notwithstanding, we're told how we're lots of jobs created. We're having 400,000 last calendar year, but it actually doesn't tell the whole story.
So are we likely to see a lot of people start selling their properties, particularly if interest rates go up?
Coupled with what we just discussed, if interest rates go up, 900 people are already, 900,000 households are under stress. Absolutely, you could see it.
So, Suzanne, do we know which households have interest-only loans? Is it across the board?
It is across the board. It tends to be more investment loans, and historically investment loans have been great performers for the banks. But you look at, say, the GFC, the global financial crisis, in the UK and Ireland, it was interesting because investment loans were the ones that went into arrears first rather than owner-occupier loans, because people wanted to stay in the house they live in, were probably willing to dump at a loss something that was an investment. Half the investors are negatively geared. That's where your costs don't cover the rent from the rent and the income. So couple that with interest rate rises, we have a concern.
As you said, wages are fairly staying still, really, but jobs growth is continuing. These numbers show a couple of interesting things. First of all, female participation rates have hit record highs,
Yes.
but also the composition of work is changing with full-time and part-time.
So female participation is fantastic for productivity gains in the economy. You want to have people participating, whether they're older workers, females, bring them in. But it's, as you say, it's a composition of the jobs. The significant increase in January, about 66,000 jobs, were the part-time workers. The full-time jobs decreased by about 50,000. But look at the overall hours of work. That decreased by 2.7%. So they say about the tightening job market, we're going to get our wage increases. I'm not so sure how long that's going to take. We're going to be very patient.
Meanwhile, there are some people apparently lucky enough to actually retire early because they've been doing so well. We had some anecdotal evidence this week, in fact, of like retiring at 35. Sounds attractive. What are the consequences of that?
I must admit, I was going, you go, guy. Isn't it fantastic? He had a budget, he followed a budget, he invested in leaving the workforce at 35. On the flip side, we need to invest in our younger generation through education, welfare, all sorts of support to get them into the workforce so that they earn money and they pay tax.
They contribute. Yeah.
They contribute. You've got to have more net taxpayers than no net taxpayers. And this kind of worried me, and I'm thinking, boy, I hope you paid off your HECS debt before you retired.
So that we don't have to, because I guess that's part of why the government often wants people to work later into life so that they contribute to the economy
That's
later.
exactly, because there's some people who can't contribute, who need our support, whether they're the disadvantaged or the disabled. So to have someone we've invested a lot of money in for educating him, getting him a high salary to leave the workforce, not so keen on that.
Oh well, best of luck to him.
Suzanne Haddan,
Suzanne, thanks.
Thanks so much.
Thank you.